I was going through old Berkshire Hathaway annual reports last night, the kind of deep dive you do when you're trying to understand how the best investors think. And I landed on the 1997 and 1998 letters to shareholders. Buried in the text, almost casual in tone, Warren Buffett disclosed that Berkshire had accumulated 129.7 million ounces of silver. At the time, that was roughly 20% of the world's annual silver production, nearly 130 million ounces, a position so large it moved global markets. And here's what's fascinating. Buffett made a fortune on that trade. He got in at an average cost around 450 to 550 per ounce. Silver eventually ran to over $7, then later spiked to 13 and beyond, but Buffett exited quietly. He's never discussed the trade in detail publicly. He's never written a follow-up explaining his exact thesis or his exit strategy, and that silence tells you something. So I'm going to tell you what happened, what he learned, and why the lessons from that trade matter right now in 2026 when silver is trading in the 70s and 80s. Comment what day and date you're watching from, because this is a historical case study that applies directly to today's market. And real quick, if you value deep dives into how legendary investors actually think and trade, subscribe and comment FinTalk OG so the algorithm knows you're here for the serious work. Now here's why this story matters. Buffett is famous for stocks, for buying businesses, for Coca-Cola and American Express and Apple. He's not known for commodities. He's publicly said he doesn't like gold because it doesn't produce anything. It just sits there. And yet, in the late 1990s, he made one of the largest silver bets in modern history. That tells you something about the setup. It tells you the opportunity was so compelling that even a guy who hates non-productive assets couldn't ignore it. And if you understand why he bought, why he sold, and what he got right and wrong, you'll understand how to think about silver today. So I'm going to break down three things. First, why Buffett bought silver in 1997. The exact thesis, the market conditions, and how he accumulated such a massive position without tipping his hand. Second, why he exited, the challenges he faced, the lessons he learned, and what he said privately about the trade. And third, how to apply those lessons today if you're holding silver or thinking about it, the position sizing rules, the exit strategy framework, and the mindset you need to trade commodities successfully. Let's start with the setup. In the mid-1990s, silver was in a structural deficit. Industrial demand was rising. Photography still used silver. Electronics were growing. But mine supply wasn't keeping up. Inventories were drawing down. Above-ground stocks were shrinking. And price was still depressed, stuck in the $4 to $5 range. Buffett saw the supply-demand imbalance. He saw that silver was trading below the marginal cost of production for many miners. And he saw that inventories were so low that a supply shock could send prices much higher. That's the classic Buffett setup. Undervalued asset with improving fundamentals and a catalyst on the horizon. Here's how he accumulated the position. Berkshire started buying in July 1997. They bought quietly through brokers in London and New York over a period of months. By early 1998, they had accumulated 129.7 million ounces. That's roughly 4,000 tons of silver. At the time, that was nearly 20% of annual global production. The scale was enormous. And they took physical delivery. This wasn't paper silver. This wasn't futures contracts. Buffett had the metal moved into London vaults under Berkshire's control. That's critical. He wanted the physical asset, not exposure through derivatives. When Berkshire disclosed the position in February 1998, silver prices spiked. The market freaked out. If Warren Buffett is buying silver, something big must be happening. Price ran from around $6 to over $7 almost immediately on the news. And Buffett's thesis started playing out. Silver continued to climb through 1998 and into 2004 and 2006, eventually hitting $13 and change. Berkshire's position went from a cost basis around $600 to $700 million to a market value well over $1 billion at the peak. That's a huge win. But here's the twist. Buffett didn't hold to the peak. He started selling in the early 2000s. By 2006, Berkshire was completely out of silver. And he did it quietly. No big announcement, no victory lap, just slow, methodical distribution. And when asked about it later, Buffett's answers have been vague. He said things like, "It was the right trade at the time, but we moved on." He's never explained in detail why he exited when he did. And that's the part everyone wants to understand. Here's my read based on what we know. Buffett faced 3 challenges with the silver trade. Challenge 1, storage and logistics. Physical silver is bulky. 129 million ounces is roughly 4,000 tons. That requires vault space, security, insurance, and ongoing costs. Unlike stocks where you just hold shares electronically, physical commodities require infrastructure. And Berkshire isn't in the business of running warehouses. That friction was a constant headache. Challenge 2. Liquidity and exit risk. When you own 20% of annual production, you can't just sell it all at once without crashing the market. Buffett needed to exit slowly over years to avoid killing his own position. That's a different game than selling a stock position where you can dump millions of shares in a day if you need to. Commodities, especially physical commodities, are illiquid at scale. That limits your flexibility. Challenge 3. Opportunity cost. By the early 2000s, silver had run from $4.50 to $7, then to $10, then to $13. That's a great return. But Buffett was also seeing opportunities in stocks and businesses. The internet bubble had burst. There were incredible deals in equities. Keeping billions tied up in silver vaults when you could be buying undervalued businesses didn't make sense. So he started rotating capital. Now let's talk about what Buffett got right. He got the entry right. He bought when sentiment was terrible, when supply deficits were real, and when price was below the cost of production. That's the Buffett playbook. Buy when there's blood in the streets. He got the scale right. He went big. 129 million ounces. When you have conviction, you size the position appropriately. And he got the structure right. He took physical delivery. He didn't play with leverage or derivatives. He wanted the actual asset. But here's what he got wrong, or at least what he didn't anticipate. He underestimated how hard it would be to exit a position that large. He underestimated the ongoing costs and headaches of managing physical commodities. And he may have exited too early. Silver went from $13 in 2006 to $50 in 2011. If Berkshire had held, that position would have been worth over $6 billion at the peak. But hindsight is easy. At the time, taking a double or triple and rotating into businesses made sense. Here's the other thing. Buffett is a business guy. He loves cash flow. He loves dividends. He loves companies that compound earnings. Silver doesn't do any of that. It just sits there. And I think psychologically, holding a non-productive asset long-term goes against his DNA, so even though the trade worked, it wasn't his natural game. And once he made good money, he was happy to move on. Now let's apply these lessons to today. If you're holding silver in 2026, here's what Buffett's trade teaches you. Lesson 1. Entry price matters. Buffett got in around $4.50 to $5.50. Silver is now in the 70s to 80s. That's 15 to 18 times higher. Does that mean you shouldn't buy? Not necessarily, but it means your margin of safety is smaller. You need a different catalyst. Buffett bought into a deficit with low prices. Today, you're buying into a deficit with high prices. That changes the risk reward. Lesson 2. Position sizing is everything. Buffett went big because he had conviction and he had the capital. If you're a retail investor, you don't have Berkshire's balance sheet, so you need to size appropriately. Don't bet the farm on silver. Don't use leverage. But if your thesis is strong, don't be scared to take a meaningful position. 5 to 15% of a portfolio is reasonable for a commodity bet if you believe in the fundamentals. Lesson 3. Physical beats paper for strategic positions. Buffett took delivery. He didn't trust futures or ETFs for a position that large. If your thesis is long-term and you're worried about counterparty risk or market manipulation, bias toward physical or fully allocated storage. Yes, it's more expensive. Yes, it's less liquid, but you own the actual asset. Lesson 4. Have an exit plan. Buffett didn't ride silver to 50. He got out in the teens. Why? Because he had other opportunities, because the trade had worked, and because holding commodities long-term wasn't his strength. You need to know in advance what would make you sell. Is it a price target? Is it a time horizon? Is it a change in fundamentals? If you don't have an answer, you'll hold too long or sell too early based on emotion. Lesson 5. Commodities are different than stocks. Stocks you can hold forever if the business is great. Commodities are cyclical. They go through booms and busts. The goal isn't to hold forever. The goal is to buy low, sell high, and move on. Buffett understood that. He made his money and rotated. Don't fall in love with silver. It's a trade, not a marriage. Now let's talk about the mistakes retail investors make that Buffett avoided. Mistake 1. Buying at the top. Buffett bought when no one cared about silver. Retail buys when it's all over the news. If you bought silver at 120 in January 2026, you're underwater now. The lesson is to accumulate during quiet periods, not during mania. Mistake 2. Using leverage. Buffett used cash. He didn't borrow to buy silver. Retail investors use margin, leverage, options, and when volatility spikes, they get wiped out. If you can't hold through a 40% drawdown, you're too leveraged. Mistake 3. No exit plan. Buffett knew he'd sell when the trade worked and better opportunities appeared. Retail holds forever hoping for the moon, or panic sells at the bottom. Neither works. You need rules. Mistake 4. Ignoring costs. Buffett dealt with storage, insurance, and logistics. Retail often ignores premiums, dealer spreads, storage fees. Those costs eat into returns. If you pay a $20 premium over spot and then sell back at spot, you lost money even if spot went up. Now let's talk about the current parallels. Why does Buffett's silver trade matter in 2026? Because we're in a similar structural setup. Industrial demand is strong. Solar, EVs, data centers, all consuming silver. Supply is constrained. Mexico restricting exports. China controlling refining. Above-ground inventories are tight. And price has spiked, but also crashed, creating confusion and opportunity. The difference is price. Buffett bought at $450. You're buying at $75 or $80. That's a huge difference. But the supply-demand fundamentals might be even more compelling now than they were in 1997. Back then, photography was dying. Digital was taking over. Silver demand was transitioning. Today, industrial demand is accelerating, and there's no substitute for silver in many applications. So here's my framework. If you're thinking about silver today, ask yourself these questions. 1. What's your thesis? Is it supply deficit? Is it inflation hedge? Is it currency debasement? Be specific. Buffett's thesis was supply deficit below cost of production. What's yours? 2. What's your entry price? Are you buying at 75, at 80, at 70? And what's your cost basis after premiums and fees? Know the real number. 3. What's your position size? Can you afford to lose this money? Can you hold through volatility? If silver drops to 60, do you panic or do you average down? Be honest with yourself. 4. What's your exit? Is it a price target? Is it a time target? Is it a fundamental change? Write it down. Buffett exited in the teens. He didn't wait for 50. He made his money and moved on. What's your version of that? 5. Are you physical or paper? Buffett was physical. Are you? Or are you in SLV, in futures, in mining stocks? Each has different risk and return profiles. Know what you own. Here's what I'd do if I were allocating to silver today. I'd put 5 to 10% of my portfolio into physical silver or fully allocated storage like Sprott Slove. I'd accumulate slowly, not all at once. I'd buy on dips, not on spikes. I'd avoid leverage entirely. And I'd set a mental exit around 120 to 150, where I'd start trimming, not selling everything, but taking some off the table. That way, if it runs to 200, I still participate. But if it stalls at 130, I've locked in gains. Now let's talk about the uncomfortable truth. Buffett made money on silver, but he's never done it again. He had the opportunity to buy silver in 2008 when it crashed to $8. He didn't. He had the opportunity in 2020 when it was under 12. He didn't. Why? Because he learned that commodities are hard. They don't fit his style. They're volatile, costly to hold, and they don't compound. He made his money and decided it wasn't worth the hassle. What does that tell you? It tells you that